How the rich use debt to get richer, while everyone else avoids it. The lie we were told about debt. Debt. For most people, that word feels heavy. It sounds like stress. It sounds like risk. It sounds like something responsible adults avoid. We grew up hearing, stay out of debt. Debt will ruin your life. Only borrow if you absolutely must. And for most people, that advice is correct. But here's what nobody explains. Debt doesn't make you poor. Bad decisions with debt do. In Rich Dad, Poor Dad, Robert Kiyosaki says, the poor and middle class work for money. The rich make money work for them. He also explains something most schools never teach. The wealthy don't fear debt. They understand it. And that understanding creates a completely different financial outcome. The middle class sees debt as danger. The wealthy see debt as leverage. That single mindset shift changes everything. Understand this clearly. Debt amplifies whatever it touches. Attach it to consumption, it multiplies stress. Attach it to assets, it multiplies growth. That's not luck, that's structure. If you're serious about learning how money actually works, not how society tells you it works, make sure you subscribe to Money Mind Shift. Because here, we don't chase hype. We break down systems. And before we continue, comment the word leverage below. That one word signals you're ready to think differently about money. 1. The poor use debt to consume. The rich use debt to acquire assets. Let's make this practical. Most people use debt to buy things that lose value. Credit cards for clothes and gadgets. Car loans for depreciating vehicles. Financing vacations. Personal loans for lifestyle upgrades. This is consumer debt. It feels good immediately, but it quietly drains your income. Every month your paycheck is already committed. That's not leverage. That's obligation. Now compare that to how wealthy individuals borrow. They use debt to acquire assets. Assets that generate cash flow, appreciate over time, increase net worth. For example, an investor puts 20% down on a rental property. Tenants pay the mortgage. The property appreciates. Equity builds over time. The debt is being paid by the asset. That's the difference. Kiyosaki puts it simply, good debt puts money in your pocket. Bad debt takes money out. The middle class uses debt to look wealthy. The wealthy use debt to become wealthy. Damon John didn't scale FUBU by avoiding capital. He used strategic funding, reinvested profits, and expanded operations. He didn't borrow to consume, he borrowed to grow. Different mindset, different outcome. 2. Debt is leverage, the Machiavelli principle. Niccolo Machiavelli wrote in The Prince, "He who wishes to be obeyed must know how to command." Wealth operates the same way. If you don't control resources, they control you. Debt is a resource, but only if commanded correctly. Imagine you have $100,000. Option A, you buy one property in cash, you control one asset. Option B, you use $100,000 as 20% down payments on 5 properties worth $100,000 each. Now you control $500,000 worth of real estate. If those properties rise 10% in value, you don't gain $10,000, you gain $50,000. Same money, different structure, that's leverage. The middle class avoids debt because they fear loss. The wealthy manage debt because they understand positioning. Debt magnifies results. Leverage without intelligence is dangerous. Leverage with discipline is powerful. Jack Ma once said, "If you want to grow, you must use other people's resources." Capital is one of those resources. But growth without calculation leads to collapse. The wealthy understand the balance between expansion and risk. 3. Borrow low, invest higher. One core principle of intelligent leverage is simple. Borrow at a lower rate than your investment returns. If you borrow at 5% and invest at 12%, the difference becomes profit. That spread compounds. Businesses operate this way. Private equity operates this way. Real estate investors operate this way. They don't obsess over interest alone. They focus on return. The middle class hears interest and panics. The wealthy hear interest and ask, what is the yield? For example, an entrepreneur borrows $200,000 at 6% to expand a business producing an 18% return. The debt costs $12,000 annually. The expansion generates $36,000. That $24,000 difference accelerates growth. But here's what separates them. They calculate first. Warren Buffett has repeatedly emphasized understanding risk before deploying capital. He doesn't gamble. He analyzes probability. The wealthy treat debt like a scalpel. Precise, intentional, controlled. The middle class treats debt like fire. They either avoid it completely or misuse it and get burned. 4. Cash flow is the first filter. This is where everything separates. The wealthy obsess over cash flow. Before taking on debt, they ask, can the asset cover the payment? What happens if income drops? Is there a margin of safety? A real estate investor analyzes mortgage, insurance, taxes, maintenance, vacancy rate. If rent doesn't exceed those costs with cushion, they walk away. No emotion, no hope, just math. Machiavelli warned leaders to anticipate threats before they appear. Wealth building works the same way. The middle class buys based on optimism. It will probably work out. The wealthy buy based on protection. If everything goes wrong, can I survive? That's control. Debt becomes dangerous when income depends on perfection. It becomes powerful when income exceeds obligations comfortably. Many high earners are broke, not because they lack income, but because they use debt emotionally. Meanwhile, disciplined investors quietly build wealth using the same financial tools. Same system, different mindset. If this shifted your perspective, comment control below, because that's what separates leverage from liability. Point 5. The wealthy use debt to preserve liquidity. Here's something most people misunderstand. Sometimes the wealthy borrow money, even when they already have cash. Not because they're broke, because they're strategic. Liquidity is power. When all your money is locked into one asset, your flexibility disappears. But when you use structured financing, you preserve capital for future opportunities. Imagine an investor with $500,000 in cash. They could buy one commercial property outright, or they could put $100,000 down, finance the rest, and keep $400,000 available. Now, if a discounted deal appears, if the market dips, if a business opportunity surfaces, they're ready. Cash creates speed, and in investing, speed creates advantage. This is why many successful companies carry manageable debt even when profitable. It allows them to allocate capital efficiently instead of freezing it in one place. The middle class thinks, if I have the cash, I should just pay it off. The wealthy think, what is the highest return use of this capital? That question changes everything. Debt, when structured wisely, allows your money to work in multiple places at once. It's not about owing money, it's about optimizing capital. 6. Risk management psychology, fear versus calculation. Let's talk about the real issue. Debt is not just financial, it's psychological. Most people avoid debt because of fear. Fear of losing money, fear of uncertainty, fear of repeating past mistakes. But fear is emotional. The wealthy replace fear with calculation. Niccolò Machiavelli wrote about anticipating threats before they arise. Strong leaders don't pretend risk doesn't exist. They prepare for it. Wealth works the same way. Before taking on leverage, disciplined investors stress test the opportunity. They ask, what happens if revenue drops 20%? What happens if interest rates increase? What happens if the market slows for 2 years? If the deal collapses under minor pressure? It's not leverage, it's speculation. Warren Buffett has said, risk comes from not knowing what you're doing. The middle class sees debt itself as the risk. The wealthy see ignorance as the risk. Knowledge reduces uncertainty. Structure reduces fear. Debt magnifies what's underneath. If you're impulsive, it magnifies chaos. If you're disciplined, it magnifies growth. That's why financial intelligence matters more than salary. Debt exposes character. 7. Productive debt versus destructive debt. Let's simplify everything into one clear distinction. There are 2 types of debt. Destructive debt, credit cards for lifestyle upgrades, car loans for status, personal loans for consumption. Productive debt, rental property generating income, business expansion with proven demand, investments with strong probability of return. One drains income, one builds assets. The middle class often experiences destructive debt first, so they conclude all debt is dangerous. But the wealthy separate the tool from misuse. Damon John didn't use capital to impress people. He used it to scale distribution and production. Jack Ma didn't avoid outside resources. He leveraged them to expand infrastructure and dominate market share. The tool wasn't the difference. The strategy was. Productive debt is tied to cash flow. Destructive debt is tied to ego. One compounds wealth, the other compounds stress. And here's the truth most people avoid. You cannot scale significantly without leverage of some kind. It may be financial leverage. It may be time leverage. It may be team leverage. But growth requires expansion, and expansion requires structure. The real difference of debt. Debt is not the enemy. Mismanagement is. The poor use debt to consume. The middle class avoids debt out of fear. The wealthy use debt to acquire, expand, and preserve flexibility. They borrow strategically, invest intentionally, protect cash flow, stress test risk, preserve liquidity, separate emotion from math. Debt is an amplifier. Attach it to liabilities. It multiplies pressure. Attach it to income-producing assets. It multiplies growth. But understand this clearly. Leverage without discipline destroys faster than it builds. That's why many high earners stay broke. Not because they lack income, because they lack structure. Meanwhile, disciplined investors quietly build wealth using the same financial system available to everyone. Same economy, same banks, same tools, a different mindset. If this shifted how you see money, comment the word discipline below. Because wealth isn't built on hype. It's built on discipline, structure, and control. And on this channel, we build thinkers. I'll see you in the next one.